For years, global markets have hung on every syllable uttered by the U.S. Federal Reserve, dissecting statements and press conferences for any hint of what might come next. The Fed's influence over interest rates, inflation, and the direction of the world's largest economy has made it the center of attention for investors, economists, and policymakers across the globe. Every chart, every data point, and every policy move was scrutinized for clues about the future of global growth and financial stability. The world's financial pulse seemed to beat in time with the Fed's decisions. But as 2025 draws to a close, a new and far more consequential story is quietly taking shape, not in Washington, but in Beijing. The world's gaze is slowly shifting eastward, as China's actions begin to overshadow the Fed's every move. While headlines remain fixated on the Fed, China was orchestrating a bold and high-stakes economic pivot. Faced with a slowing domestic economy and mounting internal pressures, Chinese leaders doubled down on exports, seeking to flood global markets with goods and keep their factories humming. This isn't just a minor policy adjustment, it's a radical transformation. China is making a calculated bet that the rest of the world can absorb the products its own consumers are no longer buying, even as global demand wavers. The conversation has shifted from the cost of borrowing money to the sheer volume and velocity of goods moving across oceans. China's export surge is not only reshaping global trade patterns, but also fueling new economic rivalries and diplomatic tensions. Investors and policymakers who remain fixated on the Fed risk missing the true driver of today's global economy. It's China's vast industrial engine and its growing domestic vulnerabilities that are now setting the tone for markets everywhere. The most urgent questions facing the world are no longer just about inflation in Ohio or interest rates in New York, but about overcapacity in Guangdong, unsold inventories, and the ripple effects of China's export push. This is the real story, one that will define the next chapter of the global economy. China's export offensive is unprecedented, an economic maneuver on a scale the world has never seen before. In just a few short years, China has transformed itself into the world's factory, churning out everything from smartphones to electric vehicles at a breathtaking pace. Its 2025 trade surplus has soared past $1 trillion, a milestone that no other nation in history has ever reached. This staggering figure is more than just a number. It's a symbol of China's relentless drive to dominate global trade. This surplus is the result of deliberate top-down policy. With weak domestic demand and a collapsing property market threatening growth, Beijing responded by turbocharging its factories with massive subsidies and ultra-cheap loans. The result? A tidal wave of competitively priced goods flooding global markets, from consumer electronics to green technology. The strategy props up GDP and keeps millions employed, but it also creates a dangerous dependency on foreign demand. China's economic engine now runs on the willingness of other countries to keep buying its goods. In November alone, China posted a $111.68 billion monthly surplus, an amount that would be an annual figure for many economies. The scale is almost hard to fathom, and it's raising eyebrows in capitals around the world. This is not a nuanced or subtle trade policy. It's a blunt force push to stave off a looming domestic crisis. The government is betting big, hoping that aggressive exports will buy time to fix deeper problems at home. The gamble is clear, that global markets will remain open, and that other nations will tolerate the relentless flood of Chinese goods without resorting to protectionism or trade barriers. But as the surplus grows ever larger, so does the risk. China's economic stability now rests on the fragile ground of global tolerance, and any shift in sentiment could have dramatic consequences for the world's second-largest economy. The world is watching closely, and the stakes, both for China and for the global economy, are enormous. The outcome of this trillion-dollar gamble could reshape the future of international trade. Behind the trillion-dollar surplus is a stark truth. China's domestic economy is weak. Imports barely grew in 2025, revealing anxious consumers and stalled demand. The property sector's collapse has wiped out household wealth, leaving families cautious and spending less. Deflation and overcapacity have triggered price wars, crushing profits and fueling a vicious cycle of stagnation. High youth unemployment and a thin social safety net force families to save, not spend. These deep-rooted problems mean China's domestic demand will remain a drag for years. The export engine is running hot because the domestic engine has stalled. Exports can't fill the gap forever. China's export surge isn't just about volume, it's about agility and strategic adaptation. In the face of shifting global dynamics, Beijing has shown a remarkable ability to reroute its economic engine, keeping its factories humming and its ports busy, even as old trade routes falter. After new U.S. tariffs in 2025, Chinese exports to America plunged nearly 29%. For decades, the U.S. was China's biggest customer, but suddenly, that door began to close. Factories that once shipped electronics, clothing, and machinery across the Pacific faced a daunting new reality. Instead of faltering, China pivoted. Exports to Africa jumped 27%, and to ASEAN nations by 15%. These regions, hungry for affordable goods and infrastructure, became new lifelines for Chinese manufacturers. Beijing's trade diplomats and business leaders moved quickly to forge new deals and deepen ties. Even the European Union, despite its own trade tensions, saw a 9% rise in Chinese imports. Railways and shipping lanes were reoriented, and new logistics hubs sprang up to handle the flow of goods. This shift is no accident. It's a calculated response to American protectionism. Chinese policymakers and economists pored over global data, identifying emerging markets and crafting strategies to outmaneuver trade barriers. Chinese firms undercut local producers worldwide, backed by state financing and aggressive e-commerce expansion. Factories ramped up production, while logistics networks became more sophisticated and efficient. Platforms like Temu and Shein bypassed traditional channels, delivering ultra-cheap goods directly to consumers' doorsteps. Their rise has disrupted retail markets from Brazil to Europe, making Chinese products more accessible than ever. The result, a new global trade map, with China embedding itself as the indispensable partner for the global South. From Lagos to Lima, Chinese goods and investments are reshaping economies and forging new alliances. This isn't just economics, it's a strategic play to reshape the international order. Beijing's outreach is as much about influence as it is about commerce, building relationships that could last generations. The US-China trade artery is shrinking, replaced by a complex web of new connections that span continents and cultures. The world's supply chains are being rewired in real time. Beijing's pivot is redrawing the rules of global commerce, setting the stage for a new era where economic power is more widely distributed, and the world's center of gravity shifts ever closer to China. China's export flood is sparking a global backlash. In Europe, leaders warn of unbearable trade deficits and threaten tariffs. The EU has already imposed duties on Chinese EVs and is investigating other sectors. The US remains locked in a simmering trade war, with bipartisan consensus for tougher measures. India and Brazil are also pushing back, launching anti-dumping probes and raising concerns at the WTO. Nations once eager for Chinese trade are now wary, seeking to protect their industries from being overwhelmed. The world is turning hostile to Chinese exports. China's strategy to save its economy is turning trading partners into adversaries. The global environment is growing dangerously unstable. Unlike a black swan, China's looming crisis is a red swan, a visible, predictable risk that's being ignored. The danger: China's extreme export dependency and fragile domestic economy create a single point of failure for the world. Two triggers could spark crisis: a coordinated protectionist backlash, or a domestic implosion from property and debt woes. Either would send shockwaves through global supply chains, destabilizing markets and economies everywhere. Experts warn the current imbalance is unsustainable. A trillion-dollar surplus exporting deflation is a recipe for disaster. The red swan is the moment this snaps, threatening trillions in global wealth. The world is flying blind, ignoring the smoke from China's engines. The warning signs are clear. The time to prepare is now. If a red swan shock hits, the fallout will be swift and brutal for certain assets. Global equities tied to trade, shipping, logistics, and manufacturing giants would be first to suffer as commerce grinds to a halt. Companies in Germany, Japan, and South Korea, deeply linked to Chinese supply chains, would face collapsing demand and production chaos. Commodity prices, especially for metals like copper and iron ore, would plunge, hurting exporters from Australia to Chile. Emerging markets that became China's new customers would see their growth story unravel, triggering currency crises and defaults. Even safe havens like U.S. Treasuries would feel the pain as a global recession drags down earnings and financial stability. In a world this interconnected, a crisis in China quickly becomes everyone's crisis. Trade-linked assets are the first dominoes to fall. As supply chain risks mount, nations are shifting focus from financial assets to securing critical minerals, lithium, cobalt, rare earths, and uranium. Japan leads the way, diversifying away from China by forging partnerships with Central Asia, especially Kazakhstan, a key source of uranium and other vital materials. The C5 Japan Summit marks a new era of resource diplomacy, aiming to bypass choke points and reduce dependence on Beijing. Japan's investments in overland trade routes and mining are about resilience, not just profit. For investors, stakes in critical mineral supply chains are becoming a crucial hedge against geopolitical shocks. In a fractured world, control over essential resources is the ultimate safe haven. Japan's blueprint is a warning. Resilience is now as valuable as returns. With China's pivot reshaping the global order, investors must prepare, not panic. Start by stress testing portfolios for exposure to China's risks. Look beyond country labels to supply chain vulnerabilities. Watch key indicators. China's trade data and domestic price trends signal looming trouble or escalation. Diversification now means geopolitical and supply chain resilience, not just asset mix. Seek companies with global, flexible production and consider critical minerals as a hedge. The era of frictionless globalization is over. Volatility and fragmentation are the new normal. Those who adapt, valuing resilience and watching China as closely as the Fed, will find opportunity amid turbulence. The time to act is now.